Hi, this is Phil Chandler. Today we're talking about tax deductions allowed for driving your vehicle and what's the best way to do it and what's maybe not the most efficient way to do it. So let's just dive into it a little bit. First off, you certainly don't want to miss out on this tax deduction if you drive your vehicle for your own business or if you drive your vehicle for the benefit of your employer, somebody that you work for. So that's the main thing we want to talk about. First off, is if you're doing either one of those, you own a business and you're doing some driving, or your employer has you do some driving for them, then you need to stop and make sure you got a system set up to capture those miles or vehicle expenses, because they're very valuable and can be a big benefit to you on your tax return. So simply put, the IRS, our buddies at the IRS, yes, we gripe about them quite a bit for quite a few things, and I'm on there with you. But actually, mileage, tax deductions with mileage, is one of those benefits that they're pretty generous with. Currently, in 2018, you get to deduct 54.5 cents per mile that you drive with your vehicle for the benefit of your business that you own or the benefit of the business that you work for. So let's talk about that a little bit. First off, the miles that you get to deduct are for business purposes. So if you work for somebody else, then it's if they're telling you, I need you to drive to the airport to pick up somebody, or I need you to drive to the office supply store to pick up something, or I need you to go to a trade show or a conference, and we want you to use your vehicle. If you're working for somebody and they're requiring you to drive your vehicle for the benefit of their business, then that's a business purpose. In addition to that, if you work for yourself, then it could be a multitude of trips for various things, such as if you're going from your office to a job site, like a contractor would, or if you're going from the bank or going to the bank to make some deposits, or if you're going to the office supply store to get office supplies, or if you're going to a lunch or dinner for a business meeting, not just your normal going to KFC or going to Arby's because it's time for lunch. This has to be going to lunch or dinner for a business meeting, business purpose. Or you're going out of town to visit a potential job or to go to a conference or a trade show. Any of those things and lots more that are business related, those you get to deduct for the business purpose. So what's not considered business purposes, in other words, personal reasons, those you don't get to deduct. So it's first off, anything that's not business. And that's kind of a smart aleck answer, but that's the bottom line. So if you're driving your vehicle over the weekends or for taking the family somewhere or going vacations or going to the movies, that's all personal reasons. In addition to that, there's kind of a separate category that's called commuting. That means if you're going from your house to your job to get to work, that's commuting. From work back to home at the end of the day, that's commuting. Commuting is, while it's got its own category, is still not for business purposes. So unfortunately, that's not a deduction for you either. So before we go further, let's talk about a change in this tax deduction that happened in 2018. Actually, it's part of the Trump Tax Reform Act that got passed in 2017, but it starts in 2018 and forward. So it used to be where if you were driving your vehicle for the benefit of your employer, he asked you to do something, and there's no policy for the company to reimburse you for those miles, then the good news was you used to be able to deduct those miles on your personal tax return called unreimbursed business expenses. It's on Schedule A, so you'd have to have itemized deductions. But you could at least get some kind of deduction for those miles that you drove for the business. Unfortunately, that got removed in this Tax Reform Act. So no longer can you take those unreimbursed business expenses off on your tax return. So that means there's going to be a lot of heart-to-heart discussions with businesses, especially small businesses, because they a lot of times don't have a policy where if you're driving for their benefit, they're going to reimburse you a certain number of cents per mile, like 54.5 cents a mile. They would just simply say, all right, you can get that deduction on your personal tax return. Well, that's not there anymore. So there's going to be a lot of businesses that are going to have to start reimbursing employees probably to pay them for that mileage that they drove their personal vehicle. The business still gets the tax deduction. The individual just gets the benefit of the reimbursement from the business instead of their tax return. So first off, there's two big questions I constantly get from business owners. Whether you're a sole proprietor, single member LLC, partnership, sub-S corporation, they all ask the same question. Is it better for the business to own the vehicle, or should I own it personally? And it depends. In addition to that, two questions come up, two categories for this deduction. One is, should I use actual expenses or should I use mileage? And the difference here is that if there is some tax deduction that you can capture, you can do it one of two ways. Either you can add up all the expenses that you incurred for that vehicle, which is gas, tune-ups, tires, oil changes, and depreciation. You add all that up for the year, and if the business or if the individual used that vehicle 100% for business, then they get to take 100% of those deductions on their tax return. Or another way that you can do that is simply use miles. Instead of trying to keep up with all these receipts and try to figure out how much did I spend on that vehicle, you instead keep up with miles. And it's miles for business purposes. So that makes it a little bit simpler. So let's just say you drove 10,000 miles throughout the year for business purposes. Then what that means is 10,000 miles times, depending on the year, let's say this year, 54.5 cents. So 1,000 miles would be $545 you got to deduct on your tax return. So actual expenses versus mileage, I typically defer to mileage because it's a simpler format to keep up with. And the other side of that is with mileage, you're just keeping up with business miles. With actual expenses, you have to keep up with all the expenses, but you also have to keep up with mileage, because if it's a vehicle that's being used for a combination of personal reasons and also business purposes, let's say 10,000 miles for personal reasons, commuting, weekends, vacations, going to the grocery store, and all that kind of stuff. But 10,000 miles was used for business purposes, like trade shows, conferences, meeting customers, and all that kind of stuff. That means the vehicle was used 50% for business. Well, you first have to keep up with all the expenses that you incurred for that vehicle, but then you only get to use 50% of those expenses. So you kind of have to do two things if you're using actual expenses. Keep up with them all, but then also figure out what's the total percent that was used for business purposes. Whereas if you use mileage, you just have to keep up with one thing. How many miles did I drive this vehicle for business purposes? I think it makes it a whole lot simpler record keeping wise, and that's why I suggest it most of the time. Now, the only time where I typically suggest that a business should possibly own the vehicle is first if the vehicle is a special use vehicle. In other words, it's like a bucket truck. A bucket truck, whether it's for a painting contractor or an electrical contractor or somebody that needs a bucket truck, usually that vehicle is, you buy it simply for the business. In other words, very seldom does a business owner drive that bucket truck home and take the family out to dinner. Yeah, maybe they would. The kids would probably get a kick out of it. But typically a special use vehicle that's mainly purchased because of its capabilities for the business is used specifically for the business. Or another one is any kind of vehicle. If it's specifically purchased for the business and it's going to be used 100% for the business, that makes it easy because, like I mentioned before, you keep up with all the actual expenses, gas, tires, tune-ups, oil changes, and depreciation. But if the business owns the vehicle, which means the vehicle is titled in the name of the business, then all that stuff, all those expenses get used and put on the business expense in the profit and loss statement. That makes it a little bit simpler. And the last one I mentioned there, which is kind of a controversial answer, is if an owner needs an immediate tax deduction, then possibly the business should own the vehicle. And let me explain that. Because one of the things that you get to include when the business owns the vehicle is depreciation. Depreciation is if you buy the vehicle for, let's say, $30,000, then you get to depreciate that vehicle over a period of years. And you actually get to depreciate a big chunk of it in the first year. So if there's a business that really needs a tax deduction, he's made some pretty good profits, he needs to buy a vehicle anyway, then possibly it makes sense to buy that bucket truck or something the business is going to use specifically for the business, because he gets to take a big depreciation in the first couple of years, especially the first year. That helps him maybe defer some taxes. So that would be one answer for a controversial answer on when a business should own a vehicle. So the business owner would own as a personal vehicle. The individual should own the vehicle as an individual if the vehicle is used for a combination of personal reasons and business reasons. And the reason is like I mentioned before. So if you have to keep up with the actual expenses, but you also have to keep up with business vehicle or business mileage and personal mileage to be able to figure out how many actual miles you get to expense. So it makes it a little bit more complicated. Where if you're just keeping up with mileage, it's less of a headache, makes it a little bit easier. Or if the vehicle is bought used and not very expensive. So let's talk about what that means. So if you buy a $30,000 vehicle, but you buy it used, so it's only $15,000. Well, the depreciation that a business could take is based on what you pay for it. So if you're buying a vehicle, and I think it's a good idea to buy used personally, but if you're buying a vehicle for $15,000, the depreciation is only going to be based on $15,000. So if an individual is buying a used vehicle with not a lot of depreciation, then maybe it makes sense to have it titled in the name of the individual. Or if the owner likes to replace vehicles on a regular basis. And here's what I mean by that. You see, if you take mileage, and let's say 2018, it's 54.5 cents a mile. 54.5 cents a mile includes a number of components that the IRS comes up with. And actually, if you calculate how much it costs for the gas, it's usually somewhere around 16 to 20 cents a mile. And what makes up the other part of that, a big chunk of that, is depreciation. Actually, if you look at the 54.5 cents, I think you'd find that roughly 25 cents of that per mile is depreciation. So let's say that you buy a used vehicle, and you not only buy the used vehicle, but you keep it for a long period of time. Let's say 10 years. You're really one of those that tries to squeeze every penny out of a vehicle. Well, if business buys it, first off, if he's buying a $30,000 vehicle for only $15,000, he only gets to depreciate $15,000. And that depreciation really is deferring taxes, not eliminating. So if he turned around and sold that vehicle several years down the road, if he sold it for something more than he depreciated it, then he's going to have a gain, a capital gain. So he's going to have to pay tax on it later on. Whereas if you owned it individually, then you got to use 54.5 cents a mile each year that you drove that vehicle for business purposes. But that means you get a benefit of depreciation, because like I said, in that 54.5 cents, around 25 cents of that, or half of that, is because of depreciation. Well, if you drove that vehicle for 10 years, you get to take that depreciation year after year after year after year. And the good news is when you ultimately sell the vehicle, there's no recapture of that. In other words, you got the benefit of all those depreciations in that 25 cents. But when you ultimately sell it, there is no accounting for that depreciation that you took before. You simply just, if you made some money on the vehicle, what you sold it for minus what you paid for it, then you might take a loss or you might take a gain, but it has nothing to do with depreciation. So that's one reason why most of the time I tell individuals, if they're asking the question, should the individual own it, the business owner, or should the business own it? Typically, I say it's the individual. So how do you keep up with these miles? Well, you can do it the old-fashioned way, which is just having a notepad, a notebook sitting on the car seat. Every time you drive for business purposes, you pull out that notebook and you write it down. Or what's even fancier and kind of cool nowadays is you keep up with these phone apps. They've got all kinds of them out there. I mentioned a few of them here. Mile IQ, tax mileage, mile bug, trip log, mile tracker. There's a bunch of them. Some of them are free. Some of them you pay a nominal fee like $10 or $15. But the apps kind of make it a little bit fun, a little bit simpler way, because every time you drive, of course we all usually have our phones with us. Every time the car moves, the phone recognizes that it's moving. And every time it stops, basically the app says, all right, you just drove from someplace to somewhere else. Was that for business or personal? Swipe left for personal, swipe right for business, or some of them are a little bit different. And then it captured the number of miles. Obviously, it already knows the date. All you got to do is put in there what the purpose of the trip was. So it's kind of a cool way to do it. And then at the end of the year, you just print that out. Boom, there you got your trip log. So that makes it pretty nice. If you just keep a calendar, so let's just say you don't keep up with everything, but you do have on a calendar, however it is, that you had 5 meetings this month. Well, at the end of the month, you could go back and say, all right, on my calendar, I went 5 places. Then you could do a little GPS searching and find out from your office to wherever you went, trade show, business meeting, or whatever, how many miles that was, times 2, because it's back and forth. So you could kind of do after the fact of using a calendar and tracking it down on GPS. The main premise is whatever the system works for you. You've got to keep up with the mileage, because if you ever got audited, the IRS is going to say, you put 10,000 miles of tax deduction on your tax return. You need to prove to us or show us where that 10,000 miles came from. So you got to have some kind of system that shows the date you traveled, the number of miles that you traveled, and the purpose for the trip. You got all 3 of those, then you've got a mileage log that can stand up in an IRS audit, and that's kind of what it comes down to. So in summary, actual miles or actual expenses versus mileage, I typically think that mileage makes the most sense. You get the most bang for your buck. It makes your life a whole lot simpler. Personal vehicle or business vehicle, unless it's a special use vehicle or unless it's used 100% for the business, typically I suggest that you use the individual owned vehicle. Hope this helps. Keep track of your miles and have a good day.